Hey guys, welcome to Make Money Count. Today we're going to talk about CPI numbers. Just before the podcast, it's like a short week. We were like, oh, the podcast, we got to do a podcast. Normally I would make a joke that we have to come out here because the tens of fans that we have are waiting on us, but it's not like that anymore. It's different. We got thousands of people watching this thing.
Seems like it.
It's crazy. It's crazy. But today we're going to talk about CPI numbers. The report came out yesterday. So Marcus is going to tell us a little bit about it.
Thanks for the dazzling intro.
You like that?
So here's what I want to talk about.
Okay.
CPI numbers came out, and they are kind of like three different numbers within the CPI numbers that we're going to look at, right? There is the general CPI number that gets released, and then there's the core CPI and trim CPI, which are the numbers that the Bank of Canada looks at.
Right.
So first things, let's set the kind of baseline. What we know is that today the Bank of Canada's overnight rate is 3%.
Right.
We know that the prime rate is 5.2%. I mean, it's a great opportunity to just say that we're going to continue to see variable rates drop, and we're going to continue to see compression on the spreads for variable rate mortgages, which is like that's our job. Our job right now is to explain to people that variable rate mortgages are going to look less and less appetizing, less and less enticing as more and more demand grows for variable rate mortgages. Mm-hmm. So that spread where we used to be prime -1 on a variable rate mortgage is going to continue to compress.
Yeah.
So the sooner you make the decision to pivot to a variable rate mortgage from your existing fixed rate mortgage, it's probably the better. If you haven't done so already, it's a good idea to get in touch with somebody about it.
And to note, I talk to people all the time who are, I'm going to wait. Let's see what happens in the market. I'm going to, my mortgage is coming up for renewal in June, July, whatever the case may be is. The longer you wait, if you're going to take a variable rate mortgage, which is probably the way to go, depending on, your risk appetite and what you're looking to achieve. But if you're looking to take a variable rate, don't wait.
Yeah. So the CPI numbers that came in are going to affect the next Bank of Canada rate decision, which is on March the 12th. So all of what we're going to say today, we're going to be talking about the CPI numbers. We're going to be analyzing why the CPI number came in 10 basis points higher than what was expected. They were expecting a 1.8 print for January. They got a 1.9. Generally, they being the economists, the pundits. More importantly, we're going to look at the trim and the core CPI numbers, which were also higher than what were expected. And also, those are the numbers that the Bank of Canada really kind of keys in on. And we'll explain that to you a little bit. But we need to preface this by saying that in advance of the March 12th date is the March 4th date imposed by Trump and the Americans with respect to the 25% tariff. So although the inflation readings look slightly higher than where the Bank of Canada will want them, and taken alone, void of any tariff talk, would likely cause the Bank of Canada to pause. And the forward markets, reading the forward markets as to what the market is anticipating the Bank of Canada to do, show that there's a decreased probability in the marketplace that we're going to see a 25 basis point cut in March.
Right.
That being said, this is a relatively small factor influencing interest rates. The very big factor is the March 4th tariff deadline, which may come and go with another extension. At this point, like the stock market in general, the markets in general are paying less and less attention to Trump's continued tariff talk.
I just picture towards the end of Trump's, being in power, his administration, being and here we are, it's the 40th time that, they've pushed the tariffs. We got one more month, you know what I mean? How long does it go on for?
Yeah. You know what? I think that he has so many different battles that he's waging simultaneously that we can kind of only hope that some of the other battles start picking up steam. Like he's got the Ukraine battle. He's going against Europe now. Like he's got so many wars that he's waging. Maybe Canada falls away a little bit.
Yeah, he
but
just
who knows?
forgets about it.
Who knows? I don't know. He seems to have the capacity to deal with a lot at once.
Yeah.
So let's get right into the CPI number. So if you don't mind pulling up the StatsCan numbers, so far we've had 6 cuts, right? Then StatsCan comes out and tells us that CPI is up 1.9%. We were expecting 1.8. Without gas price increases, we were at 1.7.
Right.
So we did see an increase in gas price and energy costs affecting things. If you click on, scroll down a little bit. If you click on chart 2 there, chart 2 goes through the increases and decreases in the components of CPI. And you can see some of them are more dramatic than others. The reason why the CPI number is scarier than it would normally be is we had this GST holiday.
Yeah, I was going to say, well, how did that affect things?
So the GST holiday provided the first ever in quite some time drop in food prices. So food prices decreased at 0.6%, which was driven by a 5.1% decrease in restaurant pricing.
Right.
That's because of the GST holiday.
Right.
So without that, and we can look at some of the different banks and their economists' interpretation of the CPI numbers, namely Scotiabank, who is out of the group the most bullish on the Canadian economy, the most against decreasing interest rates. Mm-hmm. And Scotiabank is saying essentially like there's absolutely no reason to drop interest rates by 25 basis points. Right. Again, the Scotia economists' material really doesn't address the coming tariffs, the possibility of the coming tariffs, which would take all of this data off the table.
Yeah.
We know like underlying all of this CPI information is still a very, very weak consumer sentiment, very weak customer or consumer spending numbers, and like downward pressure on housing prices, increases in listings. So the fundamentals of the Canadian economy are still not good. And when you look at those fundamentals, it really does pay credence to the idea that the Bank of Canada needs to lower interest rates. Mm-hmm. I just think that given the opportunity now to pause when the market generally expects a pause, if we do not see tariffs come in on March 4th, March 12th will be a pause. Right. I don't think the Bank of Canada drops 25 basis points. And I think that this CPI information helps them to hold off.
Right.
Next up, why don't we push up the bond yield chart? So bond yields are up, right? And this is in response to the CPI data. We're up about 30 basis points from where we were at our low. Again, this is long-term borrowing rate, risk-free borrowing rate yields in Canada, and it is indicative of what we're seeing, an expectation that we're not going to get the 25 basis points that we kind of thought we had. Mm-hmm. So I want to, this might be a little bit boring, but it is kind of important to address. So within that CPI bundle of goods, gas was a big factor impacting things. Mortgage interest costs, still a big factor pushing our CPI higher. So, and in most of the press releases that we read, we hear economists and reporters talking about CPI trim and core CPI. So I want to pull that up right now so we can have a look at it. So on the Bank of Canada's website, there is a link which explains core, median, and CPI trim. So if you pull that up for us. Okay, so let's first explain median CPI. Okay, so median CPI was 2.6% in December, is 2.7% for the month of January. And this is the centermost component of the CPI basket. So what this does is it takes kind of like the 50th percentile in the basket, the median point of the basket, and tracks that.
Right.
So it kind of it's both median and trim are an attempt to extract the components of the CPI that are more volatile.
Right.
We spoke about this briefly in the past, where it's like it takes out kind of weather events that might affect pricing, takes out the items in the basket of goods that go that increase too much or decrease too much to give us like an underlying theme for the CPI. And these are the numbers that the Bank of Canada tracks. So CPI median is a measure of core inflation corresponding to the price change located at the 50th percentile in the basket. And it helps filter out all of these big movements.
Right.
This number is trending higher. And this is a number that the Bank of Canada tracks clearly. And that's a key reason why we're going to see a pause.
Right. Not as high as the overall CPI number, but
higher.
Yeah.
Higher. So the overall CPI number was 1.8.
Oh, right.
Right.
Okay.
It was expected to be 1.8. Came in at 1.9. Median CPI rose to 2.7% from 2.5%.
Right.
On a year-over-year number. And CPI trim, which excludes the big ones on either side. So it takes out the 20% of the CPI numbers that are in the high end of the basket and the 20% that are in the low. So strips out about 40% of the items and gives you the middle 60% of the items and tracks those. That also came in at 2.7%. So both of these CPI numbers higher than where the Bank of Canada likely wants to see them, and both of them ticked up higher. So this is what the Bank of Canada is seeing and will worry them a little bit. Again, these numbers are going to get impacted in the future more, and they're going to be impacted by certain things that will no longer be there. One of those things is this GST holiday.
Yeah.
So if we strip out that GST holiday and the impact of the GST holiday, it's likely that we're going to see these numbers go higher. And the Bank of Canada does not want to see that.
Right.
So given the opportunity to pause, Bank of Canada is going to pause.
So this might sound like a silly question. And so if the GST holiday was there to kind of like make everyone feel a little bit richer and spend money elsewhere too, right? You know, if you're saving money on the groceries and you're saving money at the restaurants, you may be spending money elsewhere. Wouldn't it be the opposite effect? Wouldn't there be like some sort of...
No, because the basket of goods measures the changes of the price of the goods.
Right.
And included in the price of the good is the GST.
Right.
So you basically just took out 13%.
Yeah.
Out of the price of the goods that received the holiday. And again, like not every restaurant and vendor was offering out that holiday, I think, right?
Mm-hmm.
Like
Boston Pizza was.
I didn't see it everywhere, but
Boston Pizza was.
Definitely it impacted the numbers by reducing prices. Mm-hmm. That's why you saw food prices drop. Food prices would never drop.
Yeah.
Right?
Hasn't happened in forever.
So the fear is that in the coming months, without the holiday, prices will go back up. Right. And what will that do to the month-over-month CPI differences? I don't know that it's going to be a huge impact, and I think that on the backdrop of continued pressure on mortgage interest rates and rental pricing, so like included in this is like rents are dropping, so we're not seeing increases in rents. Mortgage interest rates, we're ticking higher still because people are renewing their mortgages. That's going to start coming off.
Yeah.
So we're hopeful to see continued downward pressure, but there are some it does create some confusion for StatsCan and for the numbers that we're seeing. Again, all of it points to if we don't see tariffs, we're not going to see a 25% drop.
And if we see tariffs?
And if we see tariffs, like, who knows what we're going to see? We could see a 1% drop.
Yeah.
Right? Like, the damage to the Canadian economy that tariffs will do is so significant that, like, we spoke about it a week or two ago. Like, the Bank of Canada really doesn't have a playbook for it.
Right.
And doesn't really have, like, the tools to deal with it. And as a result, they're just going to drop rates.
Right.
And I don't think that dropping interest rates really will turbocharge the housing market.
Yeah.
Because what we're seeing in the housing market right now is just record listings flooding the marketplace. That is not a good sign for housing prices.
Yeah.
Like 2025 will be much like 2024, if not worse, for housing prices, because consumer sentiment is just eroding and people are trying to offload real estate, and without an expectation that prices are going up, with this overhanging threat of tariffs, CapEx spending for businesses is down. Again, I'm generally optimistic for the Canadian economy. I just think we have to get over this rough patch right now. And I think that once we've kind of settled in on where this tariff trade war lands us, we should be optimistic about the future for Canada. I just think right now, this uncertainty, markets do not like uncertainty, and more so Canadians don't like uncertainty. Like, look at what we're dealing with right now. The Canadian consumer doesn't want to really spend money, doesn't want to be invested in real estate. The Canadian business owner doesn't want to continue to spend money on CapEx, doesn't know whether their business is going to be viable or whether they're going to have to open a branch in the United States in order to sell products or services. So again, I feel like we're like getting tariffed out. Like we're talking way too much about tariffs.
Yeah.
But it does affect how Canadians are going to be able to respond with their own finances. This is to say that if we don't see a rate cut in March, we're still going to see rate cuts.
Right.
So I'm not, if you remember, we said that
3.95.
prime rate 3.95, right? In order to see that, we still need to see 5 more rate cuts.
Right.
And we're going to see 5 more rate cuts. They just might not come consecutively now, and we may see a break in the month of March.
Right. I mean, we have a history of,
Oh, right.
you know what I mean?
Yeah.
So maybe taking things slow is the answer.
Yeah, I think, listen, it doesn't hurt them to wait on the 25 basis points. I think the response to that will just be kind of further weakness in the Canadian housing market, further erosion of consumer confidence, but it'll be marked by the tariffs not coming in. So if you think about it, the CPI number doesn't matter nearly as much as the tariffs.
Right.
Because if the tariffs don't come in on March 4th, there'll be optimism in the Canadian marketplace. Right. I don't, whether that means that the tariffs just get kicked out another month or two. As the tariffs continue to get kicked out, they become less of a drag on the Canadian economy.
Right.
They're still a drag.
Cry wolf situation.
Yeah, but there's still a drag on the Canadian economy. Like big investments aren't going to happen. The sooner we get it cleared out and with some certainty, the better off we're going to be. All of this is to say is usually we get these CPI numbers and we're like watching them really carefully. Oh man, it's up 10 basis points. It's 1.9. It's not 1.8. Median CPI has come in hotter. Trim CPI is hotter. The Bank of Canada must be worried. In this case, these numbers are so insignificant relative to the damage that tariffs will do to the Canadian economy and the resulting response from the Bank of Canada. So March 4th is the date to watch. If no tariffs come in, no way we see anything happen with the Bank of Canada. If tariffs come in, something more serious is going to happen with the Bank of Canada.
Right.
And again, like, it's not a good place to be when the one economic driver for our economy is reducing interest rates. Right? Like, we really would.
We
like
have
to
one
see,
red button.
Yeah.
One button.
Yeah. We really would like to see some other positivity, some other green shoots, Alan Greenspan called it, like something else happening in the economy. But right now we're not.
Right. Well, I think that's it. Yeah.
Mm-hmm.
I made this outro awkward.
No, that's okay. Listen, I think what this comes down to is we can do only so much to control what's happening, right? We can only influence how our own finances are and how they're protected in this time of uncertainty. So it really comes down to this idea that if you've got a mortgage and you've got some real estate, assess what makes sense for you right now, right? Assess whether your existing fixed rate mortgage should get broken and should get put into a variable rate. Figure out whether, you can continue to carry the real estate that you have, because it will be another 9 months of this uncertainty until interest rates drop a little bit and the tariff threat gets sorted out. And at that point, I think a lot of this will be out of the marketplace and we will start to see more renewed optimism.
Yeah.
And if we have optimism on the backdrop of lower interest rates, and no tariffs, and an American economy that continues to thrive, then Canada should be in a really good position. So there's some positivity here.
And something to note, if you're assessing your situation, assess it with a mortgage broker. Don't do it alone, and don't do it with your bank, probably.
Yeah, I mean, listen, go to your bank and get the information.
Yeah.
But don't take that information as gospel.
Yeah.
Right? Take that information as biased information coming from a third party who only benefits when you pay more. Right? Remember, the bank's stock prices and TDs. You see TDs like gone on a run now.
No, I didn't.
Well, they're divesting of some assets in the States. They sold a mortgage book of about $9 billion. And the stock price is doing a lot better now. That again, certainty has come into the marketplace for them, right? Like it's more certain of what their future is.
Right.
Canada, if we're looking at Canada like a stock, we don't have that certainty right now, right? And for everybody that is commenting that like Canada should just become the 51st state, again, you don't sell at the low. You don't vend Canada in at its lowest point. You don't vend Canada in ever, first of all. Canada never becomes the United States. Canada is Canada. And we need to protect Canada at all costs. And the stinking thinking that we're all kind of embroiled in right now will go away. And renewed optimism will come. And people will start to consider that Canada has infinite resources. Infinite resources. You know what it reminds me of? You know how sometimes we'll see a valuation on a property and it'll be so sky high and we'll send it to our internal appraiser and the appraiser will be like, the only way I could see this value coming in is if there's a gold mine in the backyard.
Yeah.
Or there's
an oil
is there an
deposits.
oil
Yeah,
well?
yeah.
So like Canada has that. And we're not taking that into consideration right now. Right? Like there is an inherent value in not just the people of Canada, but the natural resources of our country, the fresh water, the resources. Like it's infinite. And we got to start thinking like that. And the more we start thinking like that, the better it's going to be for us. We won't have to worry about interest rates all the time.
I feel like we ended this on a positive note.
I try.
That was solid. All right, guys.
Thank you.
Thank you.